Hi there, welcome to Commodities. I'm Andrew Bell. Let's check in on the energy complex right now. Now, for much of the day, we've seen higher oil prices, and naturally that's because of geopolitical tensions. We are going to hear shortly, we hope, from Halima Croft of RBC. She is in the camp that says the market may well be underestimating geopolitical risk in oil. For example, Iran, there's probably more shoes to drop there. There is the risk that a desperate regime tries to block the Strait of Hormuz. That's going to be one of our topics today as well. Speaking of geopolitical worries, let's have a look at the metals. Gold hitting a new record high today. It is off the highs of the session, but moving up. And look at that, silver down. Remember, we heard from a BMO analyst yesterday that silver may be getting inflated, at least relative to gold, because the ratio we've seen lately dropping to where you only needed 50 ounces of silver to buy an ounce of gold. And that is the lowest price for gold in silver terms since 2013. So it looks like investors are getting some misgivings over silver after its massive run-up. And we have seen a bit of fresh selling in copper today. Copper is not far off record highs, but there are fears that the Chinese may balk at the current high prices for the red metal, and they are the big consumers. Later on the show, speaking of copper, we are going to get some ideas in renewable power. The Trump administration certainly not in favor of energy generation or electricity generation from wind and solar. But we'll hear from Mizuho that there are reasons to buy some of these renewable energy stocks, in particular solar. And let's have a look at where the agricultural commodities are trading. We're seeing a mix showing there. Soybeans up around 1%, corn slipping, and wheat futures also under a little bit of pressure. Couple of other commodity stories that we're watching. Alberta may be facing its toughest fiscal situation since the pandemic. The fear is that a possible flood of Venezuelan oil will help to depress the price of heavy crude, one of the province's biggest sources of revenue. U.S. President Donald Trump says Venezuela will release as many as 50 million barrels of oil after U.S. forces captured or seized the president, Nicolas Maduro. And the prospect of millions of barrels flowing to the U.S. Gulf Coast refineries have helped to widen the discount on Canadian crude. And Teck Resources shares moving up 6% after the company reported strong production in the fourth quarter, topping expectations, and it reaffirmed its forecast. This is a Canadian diversified mining giant, and it produced 130,000 metric tons of copper in the quarter, thanks to a strong performance from its Quebrada Blanca mine in northern Chile. Now, of course, that has been giving the company trouble. The ramp-up has been more difficult, and that has helped to weigh on Teck Resources stock. Maybe we could put up a 5-year chart for Teck. The actual results, though, from Teck losing relevance because the company is poised to be bought by Anglo American. You can see Teck, though, moving up, hitting multi-year highs. And finally, Birchcliff Energy is on the radar. The company releasing its updated 2026 budget and 5-year forecast. Record average production in 2025 was driven apparently by improved capital efficiencies and lower costs. And Birchcliff has set a new target of producing more than 100,000 barrels of oil equivalent per day by the end of the year. Let's get back to oil. Crude topping $60 US today amid geopolitical risk. Our guest says that given current global uncertainty, people should not be underestimating hazards to supply, the risk that we will see significant disruption of oil flows. We're joined by Halima Croft, Global Head of Commodity Strategy at RBC Capital Markets. Always great to see you, Halima. Thank you very much for joining us.
Thank you for having me.
Do you think there's a little bit of complacency on the oil market about the threat to supplies?
Well, I think at the end of the year, we had really discounted, or many market participants had discounted the risks of geopolitically driven supply disruptions. And what we're seeing now, I mean, part of the reason why oil is at the current levels that it's at is because of disruptions that we are seeing related to the Russia-Ukraine war, particularly disruptions related to key pipeline infrastructure like Kazakhstan's CPC pipeline affecting loadings. Now, there are other issues on Kazakh production as well, but certainly the ongoing Ukrainian attacks on Russian infrastructure, Russian pipelines, on tankers, is really starting to cause material disruptions in the market.
What about the Trump Greenland saga? Of course, it's been called that. I guess the Icelanders invented the saga. But of course, that could cause economic disruption, which would tend to push down oil if tariffs are slapped on.
So funny you mentioned Iceland. I'm actually married to someone from Iceland, and I'm headed to Iceland tomorrow. But I think that has been a factor weighing on prices. And certainly we are going to be waiting for more details on the proposed NATO framework for Greenland. Certainly, Denmark has rejected the idea that they are going to sell Greenland. So we really have to wait and see how this gets resolved. But I think Greenland's a really important point of conversation because certainly what President Trump has talked about since December is his Western Hemisphere strategy, the Dunroe Doctrine, or we call it the Monroe Doctrine 2.0. And Greenland is part of that. But also Venezuela has been really part of that. I mean, that has been one of the key factors behind the U.S. move to seize Nicolas Maduro and essentially take control of Venezuelan oil exports is the idea that the United States is going to throw its weight around the region. And again, when it comes to oil, we've really seen that play out for Venezuela.
Could we just swing to Iran for a second? Because you guys note that a lot of Iranian oil shipments seem to be unaccounted for. It's not clear where they're all going.
Yes. Well, certainly we know that the lion's share of sanctioned Iranian barrels end up in China. They end up in the Chinese independent refiners known as teapot refiners. Now, there are some interesting exports from countries. I think we've talked about this before. Malaysia. Sometimes we look at the Malaysian exports and we say, are these really Malaysian barrels or are they Iranian barrels disguised as Malaysian barrels? There's been conversations previously about Iraqi exports. Are they all Iraqi barrels? Are there some Iranian barrels mixed in? Is there an effort to basically rename barrels to evade sanctions? But I think what's going to be interesting as we think about the Iran story, because we simply don't know where President Trump stands at the moment on intervention in Iran. We have deployed, the U.S. has deployed more military assets to the Middle East. There's some anticipation of a possible U.S. strike. What would that mean for the security of Middle East oil assets?
Could we just swing back to Russia? And you guys have prepared a map of Ukrainian attacks on Russian facilities or vessels, I think, in some cases, since 2025, the summer of last year, I believe.
Yes.
And are they actually disrupting Russian oil shipments significantly?
Well, that's why we brought up the issue of Kazakhstan and the disruptions that we're seeing at their biggest fields. And a lot of it is tied to the inability to move those exports through, critical facilities. And we have seen Ukrainian attacks on CPC terminals, on infrastructure. And so most notably right now, we're paying close attention to what's happening with those exports. But they have also been relentless, Ukrainians, in attacking Russian refineries. They've stepped up attacks on shadow fleet tankers. And at a certain point, the combination of existing sanctions on Russian energy, Ukrainian attacks on critical Russian energy infrastructure, the question is, will we start to see even more serious Russian supply disruptions? Because one of the Achilles heels of the Russian energy system is an actual lack of abundant storage. So some experts are saying at a certain point, the combination of these Ukrainian attacks and the storage shortfalls will mean that Russia will have to shut in more barrels.
Halima, thank you very much indeed for joining us. Halima Croft,
Thank
Global Head of Commodity Strategy at RBC Capital Markets. Up next, we've seen shares in Allied Gold surging over the past year. We'll hear from the CEO next. Shares in Allied Gold are up around fourfold in the past year, and that outpaces the gain in the TSX Gold Index, which of course has more than doubled. Now, Allied has a big mine in Mali in West Africa, and it's nearing production at its Kurmuk gold mine in Ethiopia. Canaccord sees total output for the company hitting almost 550,000 ounces this year, and that will be up 45% from last year, and then getting to 660,000 ounces next year. We are joined by the CEO, Peter Marrone. Peter, great to see you again. Thanks very much for coming on the show.
Andrew, it has been such a long time. It's great to be with you.
Yeah, so no mine is simple to build. There are massive engineering achievements, but apparently Kurmuk is a fairly straightforward project.
It is, but as you said, if mines are complicated to build, and particularly in jurisdictions that want to encourage mining, Ethiopia certainly is that, but has not had historical development of mines, certainly not large-scale mechanized mines. We have to be sensitive to that, and we have to say, let's take a little bit more time to make sure that the engineering is right, that the procurement and supply chain is done as efficiently as possible, that we've worked with local communities, with local governments. We took a little bit of that extra time at the beginning of this when Allied went public in September of 2023. I said, we'll take an extra 6 months to 9 months to put all of those things in place. I'm happy to say that the result of that is that we're now very close. By April, we start commissioning this mine. And by the third quarter, we will be in production.
And you're blessed, apparently, that the nearest settlement is quite a few kilometers away, maybe 8 kilometers away. So you didn't have to resettle people?
Well, we did not. Now, there are local communities. We will be hiring locally. That's a very important practice of ours. It's part of the policies of this company. But there are local people. We will have a camp at which they stay. But you are correct that there are not local communities, but frankly, there's support for this mine and there's support for mining in the country, and that has to be said as well.
So your production next year, according to Canaccord, could hit about 660,000 ounces between, your two biggies are Mali and Ethiopia. Does that sound in the ballpark?
So part of what we've been doing for the last couple of years, since again going public, just a little over 2 years, is stabilizing the existing operations, spending some capital on stripping in the case of the Côte d'Ivoire mines, finding new ounces of oxides. Sadiola is transitioning from an oxide mine to one that processes slightly harder rock, fresh ore. But it's interesting because that mine has already produced close to 9 million ounces. But as it transitions, we have more than 10 million ounces already in inventory, and that number is likely to continue to grow. We've made discovery of new oxides, but we've also completed the first phase of a 2-phase expansion at that mine that ultimately takes it to 350,000 ounces per year. That first phase and some of the other optimizations and the discovery of the oxide ounces to supplement our production is important because it stabilizes that operation for certainly the next handful of years at least 200. We estimate 200 to 230,000 ounces per year. Now, this is a mine that, as it transitioned and as it was coming to the end of the mine life of its oxides, in 2023, it produced barely 170,000 ounces. Here we are now producing in the order of 200 to 230,000 ounces, and that in itself is a very positive movement on that operation. The second phase will allow us to process more of that fresh ore through that plant, the result of which is that the production platform is expected to be closer to 350,000 ounces, with, of course, a further improvement to its costs.
Now, Mali, of course, run by a military junta, and Barrack has had trouble there. It looks like they've resolved the dispute with the government. You signed a deal, I believe a 10-year deal in late 2024 with the government. Is everything copacetic there, or are you in further talks with the government in Mali?
Well, we took an approach, Andrew. It's interesting because the approach that we took, not dissimilar to many of the things that in the predecessor company that this management ran, Yamana Gold, we did in South America, recognizing what the government was looking to achieve, the creation of a mining industry rather than just companies coming in to extract. We took a reconciliatory approach in 2024. We entered into a protocol agreement. We received our permit extension for that 10 years to which you refer. And we've been in dialogue with the government of the country on what else can be done on our part and on their part to further improve the mining situation in the country. Look, let's face it, that Birimian belt on which this mine is located is one of several mines. And I can't think of a place where you can find a handful of mines that produce between 200,000 ounces per year and 500,000 ounces per year. So this is prolific. It is an exceptional precious metals mining place. I believe that the government of the country recognizes that. They're trying to find a way to provide more take on the part of the state, while at the same time also encouraging mining. We've been in dialogue on the ways that could occur. We will continue to be in dialogue. I think it will lead to a positive result.
Thanks very much, Peter. Really appreciate it. Peter Morone, Chairman of Executive Gold, also CEO. Right up next, we are going to check out some investment opportunities in clean energy amid this gigantic AI data center expansion in the US. Current U.S. administration not keen on renewable energy, removing incentives in some cases. Let's get an outlook for that sector and some stock ideas. We're joined by Maheep Mandloy, Senior Analyst in Clean Energy and Renewables at Mizuho Americas. Thanks very much indeed for joining us. Is it fair to say, though, that renewables are still expanding rapidly in the United States?
Thanks for having me, first of all. And absolutely, you're right. We are entering a phase of expansion here. The administration has cut down these tax credits, which in most cases end starting 2031. But because of that, we'll see a rapid expansion ahead of that, kind of a demand pull, if you will, in utility scale, solar, and residential. And none of this has benefited from the AI race yet. So that's a long-term opportunity if that comes in. But we're definitely excited about that. We like First Solar on the solar module manufacturing side and Sunrun on the residential solar side.
Well, let's get to a couple of those stocks. Start off with First Solar. Just remind us what they do. They're a big maker of solar modules, and of course, they're not Chinese.
Yeah, exactly. They are probably the only big, large-scale solar module manufacturer globally, which is A, not Chinese, and B, not dependent on the Chinese supply chain. They have a different technology called a thin film, and everyone else uses something called a crystalline silicon technology. So that becomes pretty important. If you look at what the priorities of this administration is, it's nearshoring, moving away from the China supply chain, and flexible load. First Solar ticks through two of those boxes, and hence why it's our topic.
That's interesting. All right. Just their technology is different, and that lets them avoid dependence on China. Sunrun is a big player in domestic installations of solar, other aspects. What draws you to that stock?
Yeah, so Sunrun is a residential solar developer, financing company. They have multiple hats, but basically they are the largest solar leasing company in the US. And one interesting thing which happened under these new rules under the One Big Beautiful Bill, the incentives for solar loans or cash sales, like for customers, you and I, those end starting this year. But the incentives for solar leases are available for the next 4 years. So Sunrun, being a leader capitalizes on it, and we think they'll have above market growth rates for the next few years in this industry.
And then finally, you have an engineering company, Mastech, and they, of course, a big player in electric infrastructure build-out.
Yeah, they are a diversified engineering procurement construction company, or EPC. They do EPC for utilities, building the transmission distribution grid, and they do power generation, renewables as well. But one thing which we're more interested on them, or what we like for them, is they also do natural gas pipeline construction. With all the focus on data centers, that's something like a derivative. All the data centers would need natural gas power, or are using natural gas to power themselves. And those would require expanding the existing pipelines or adding new pipelines. And Mastech is at the forefront of that, the leader in that, and they benefit from that trend, which should transpire over the next 2 years.
Maheep, thank you very much indeed. Really appreciate it.
Thanks for having me.
Maheep Mandloy, Senior Analyst in Clean Energy and Renewables at Mizuho. Now, beer is one of humanity's great commodities. Might have been even the reason why people stopped being hunter-gatherers. They needed to settle down and grow grain and brew the beer. In any case, one of the most famous marketing campaigns in beer has been the world's most interesting man, an elderly chap who's far more proficient at everything than us younger guys. Now, the campaign was a huge hit, but some years ago, Dos Equis beer dropped him. It's owned by Heineken, but they're bringing him back. Yes, the most interesting man in the world is back. His achievement, of course, he's famous for the catchphrase, I don't often drink beer, but when I do, yep, it's Dos Equis. The actor is now 87 years old, and Heineken hopes that it's Jonathan Goldsmith. He went away in 2006, 87 years old. They're launching a massive campaign bringing him back. And just to remind you, his achievements include being able to parallel park a train. Apparently, he's so interesting that his phone is addicted to him, and he also is able to speak French in Russian. So we're all welcoming him back. He was a cult figure in marketing and generally in society. 87 years old. I think there's hope for me yet. And it looks like some kind of drama is playing out there, so we'll have to watch the ads. But apparently it's going to be on billboards, social media, and other digital venues. Heineken is doing a big push here. And meanwhile, of course, the US beer market has been languishing, but he's back and he'll fix that. Thank you very much for watching Commodities. We'd love to hear from you. Commodities at BNN Bloomberg.ca. The close is up next.